Test, test. Okay. Good afternoon and welcome to Chapter 19. Chapter 9, we're going to talk about additional discussions with cost, volume, profit analysis, in addition to what we've covered in Chapter 18. We're going to discuss again some of the essentials of the cost, volume, profit income statement. We're going to apply some of the cost, volume, profit concepts we learned in Chapter 18. We're going to explain what's meant by sales mix and the impact of it has on break-even sales. Look at sales mix with a company with limited resources, and also what happens with operating leverage. And operating leverage is really a function of the cost structure of a business between fixed and variable cost. Cost volume CVP analysis is the study of effects of changes on cost and volume on companies' profits. In other words, what happens when sales volume goes up or down? It's very, very important to profit planning, and you can use it to determine production mix, also looking at what you're going to do from production facilities, and also to establish selling prices are huge things for a business to determine if they're going to make money or not. More often than not, management will look and ask for a special format income statement which segregates out fixed and variable cost. And what you're going to do in that income statement is you're going to look at something called contribution margin, which is variable cost less selling price is going to give you contribution margin. And that contribution margin is going to be on a total and on an amount basis. And those are the things that you're going to need to be able to do some of these calculations for cost, volume, profit analysis. So here's a review from what we looked at in Chapter 18. And you notice here what you have is you have sales. And this says that they sold 1,600 camcorders. This was in June of 2014. And they had variable cost of $480,000. And you see the per units on the right and a contribution margin of $200 per unit. So what that really says, that $200 tells you that for each unit sold, you make $200 contributing towards fixed cost. If that number were zero or approaching zero, it would probably not be a good proposition to sell that particular individual product. And then you have certain fixed costs that you're going to cover, and they're fixed costs and they don't change. And in this particular case, the company sold 1,600 units and they made $120,000 in net income. So here's a little bit more of a breakdown of the detail of the expenses. In variable expenses, you have cost of goods sold, which is the cost per unit, selling expenses, which might be commissions, and administrative expenses, a certain portion are determined to be variable. And the fixed costs, you can see cost of goods sold, selling expenses, and administrative expenses. Same basic income statement, but it's only detailed as opposed to the summary we looked at in the last slide. So let's take a look at what we want to figure out from a break even. This is still a bit of a review, but I think it's worthwhile to look at. We're going to take the fixed cost, and if you remember, the fixed cost showed that they had $200,000, and it's going to tell you divided by the contribution margin, which is $300 per unit, or $200 per unit. You can see here. So 200 divided by 200, and it tells you the break-even units are 1,000 units. You can also take this 1,000 units and multiply it times the selling price per unit, and it tells you how many units you can sell. The second thing that it does is you can look at fixed cost divided by the contribution margin ratio, which is that 40%, and it's going to tell you that your break-even point is $500,000. So there's the difference between the two. Okay. The next one you're going to look at is when they achieve a break-even, they're going to add a targeted net income. If you notice, these formulas are just a tad bit different. We've taken fixed income and we've added a targeted net income, which is $250,000. The contribution margin per unit remains the same, and the contribution margin ratio remains the same. So we have 200 plus 250 divided by the contribution margin per unit, which is $200, and it tells us that they need to sell 2,250 units to break even. And this is still a review. And then fixed cost, 200 divided by plus 250 divided by 0.4, and it says that they need to sell $1,125 in sales in order to make $250,000. Okay? Now let's look a little bit at the margin of safety. The margin of safety tells us how far sales can drop before the company will operate at a loss and can be expressed as a dollars or as a ratio. So let's take a look here at this one. It says that their actual sales were 800,000, the break even was 500. So the margin of safety in sales is $300,000. The bottom one, margin of safety in dollars divided by the actual expected sales, and the ratio is going to be 37.5%. So you can see these two, that kind of gives you a measure. So if you were a banker and you were looking at this business, it gives you an idea of how far sales can fall before the company is going to fall into the red. Okay, same kind of deal. So let's take a look at this. Here's kind of the environment we already looked at. Selling price, variable cost, fixed cost, and break even. These are all things that we've already looked at. But now what happens here? Let's look at the environment. It says, okay, here's something that could happen. A competitor is offering a 10% discount on the selling price of its camcorders. Management must decide whether to offer a similar discount or not. What would a 10% discount mean on the break even? Well, that means that they're going to reduce their cost by their selling price by $50. So that means their contribution margin is going to go down from 200 to 150. So the break even sales went up 333 units. So a 10% discount means that they have to increase their sales by about 30%, a little bit more, 33 and a third percent. The next one, what happens here? Management invested in new robotic equipment that will lower the amount of direct labor required to make camcorders. Estimates are that the total fixed costs will increase 30% and the variable cost per unit will decrease 30%. So what happens? It's kind of a hard one, right? It says fixed cost will increase 30%, so you know that's going to go from 200 to 260. And variable costs are going to go down 30%, so it's going to go from what, 300 to less 210, so that's 30%. And it says that their break even went down 103 units. So you think, why are all these important? Let's talk about that before we go to this next one. They're important because businesses have to make decisions, and they want to know the impact of those decisions on the profitability of their business and what they need to do and how many units they need to sell and at what price. So that's why these are important. And even if you're not going to be an accounting major, these are important if you're going to be a salesperson or a marketing person or a production person or a general manager. All these questions are important. Let's look at one more. Vargo's principal supplier of raw materials has just announced a price increase. The higher cost is expected to increase the variable cost of camcorders $25 per unit. Management decides to hold the line on selling price. It plans a cost-cutting program that will save $17,000 in fixed costs per month. Vargo is currently realizing net income of $80,000 on sales of 1,400 camcorders. What increase in units sold would be needed to maintain that net income? Well, let's take a look. Oh, it doesn't even tell us. This is one you want to figure out on your own because it doesn't give us a solution. But what you're going to do is you're going to say, okay, what would happen for us to maintain this? You're going to take a different variable cost and a different fixed cost, and you're going to be able to calculate this. And this is the type of question you would ask. But now let's talk about sales mix. So far, we've looked at a business that only has one product that they've sold. Well, guess what? You're going to have businesses that are going to sell more. So in this case, it says a business sells 80% printers and 20% computers. That's an 80-20 sales mix. And of course, you could see in a business where they would have a huge number of products. But in this case, it's just a little bit different. I mean, you might think of a car dealership that sells 80% new cars in their sales and 20% are service or used cars. They might break their sales down that way. That might be a way to look at it. So if we have this, they can calculate the break-even sales units based off of a sales mix using a weighted average contribution margin. So you have 75% camcorders and 25% TVs. That's the sales mix so far. But what we want to do is look at the contribution margin for camcorders and for TV. So let's take a look. So camcorders, the contribution margin is 200, but we're going to multiply that times 0.75. So that means it's going to be 150. And you're going to take 500 times 25, that's going to be 125. So you're going to add these two together, and it's going to tell you what the weighted average contribution margin is. And you notice the contribution margin on TVs is significantly higher than it is on camcorders. Let's look at the weighted average. That's what it's going to show here. 200 times 0.75, which you know is 150. And 500 times 0.1.25 is 125. So the weighted average is 275 between these two. Well, you can take that weighted average contribution margin and you use kind of the same calculation we just went through. You're going to take the total fixed cost divided by the weighted average, which is 275, and it tells us the break even point is 1,000 units. But now we need to take that 1,000 units, and we're going to use these percentages to determine how many TVs and how many camcorders. So it's going to be 750 camcorders and 250 TVs, and that's the math you'll see here. 750 and 250. And then you can take that if you wanted to and say, well, what are our selling prices for these? And it's going to tell you that the selling prices for these, you take the selling price and extend it against the units, and that'll tell you what your break-even sales are. So this is how you can do the same thing with sales. So we're going to look at that not only for products, but we can also do it for divisions or product lines. But no longer is it going to be individual products. So product lines might be 3 different golf clubs. They might be a plant division versus another type of a division within a company. But these are divisions. So here's the example that they come up with in your text. So you have an indoor plant division and outdoors. This would be house plants and garden plants, if you will. And you notice that their sales mix, and they did this on a pure dollar basis, 20% and 80%. So we're going to take the 20% and the 80%, and we're going to calculate this bottom part is the weighted average contribution margin. So we're taking the 80,000 divided by the 200,000, which is the sales, okay, and the 240 divided by the 80, and you can add those across, and it comes up with the weighted average, which is 0.32. Okay, so here's our weighted average contribution, which is going to be 0.32. We just saw that calculation. I'm going to take that 0.32 and divide it into the fixed cost of 300,000, and it says the break-even point in dollars is $937,500. So it's just like what we looked at earlier. The only difference is now this is not a simple contribution margin ratio. It's a weighted contribution margin ratio based off of the units. So we can use these to calculate our sales. And now you take the 937 times 0.2 to tell you that that's 187 for the indoor plant division and 750 for the outdoor plant. If the sales mix was 50-50, the average contribution margin would change to 35%, and the break-even point would go down to 857,143. So these numbers will help you determine what you might want to do within your business. Now, what do you do with limited resources? If you have limited resources, I'm certain some of you guys have businesses. Maybe you're no businesses that do this. Maybe you're a landscaping company and you have the choice between, redoing a flower bed or cutting the grass. And you're saying, well, which one makes more money? Well, what you find, because maybe you only have 40 hours in a week and you want to figure out how much more money you can make per hour doing each one of these. Well, here, this company has 3,600 hours per month, which is probably about 900 hours a week, which would be about, give or take 22, 23 employees if you look at it that way. Because take 900 divided by 40 would be between 22 and 23 employees per week. Okay? And it says, here's what you have. It says the contribution margin for TVs is 200 units, or for camcorders is 200. For TVs, it's 500. But you notice the camcorders take a whole lot less resources than TVs to sell. Okay, so let's take a look at what that means. Well, what we really want to look at is the contribution margin per limited resource. In this case, it's machine hours, and it says the camcorders make $1,000 per machine hour, where the TVs only make 800. So even though these two numbers are drastically different, when you start looking at the limited resources, in fact, you would dedicate more resources to selling camcorders and producing them than you would the TVs, because you get almost 30% more money, make 30% more on camcorders per machine hour than you would on TVs, presuming that demand exists. So with limited resources, here's what's going to happen. If Fargo is able to increase machine capacity from 3,600 to 4,200 hours, the additional 600 hours be used to produce either camcorders or TVs. Well, which one would you pick? Obviously, if you pick camcorders, they could make another 600,000. If they pick TVs, they're only going to make 480. Presuming there's enough demand, the profit increase by adding another 600 hours for camcorders is 120,000 more units than TVs. The theory of constraints says that company must manage, and this is actually by Eli Goldratt, use must be approach must be used to identify and manage constraints so as to achieve company goals. In other words, they have certain restraints within the business and they have to manage against those. And they must continue to look at constraints and make certain that they can eliminate and address those. And they go from one constraint to another constraint to another constraint until they find where there's issues and goals and they get them resolved. And they move to the next one and it allows them to maximize their profitability. Cost structure and operating leverage. What this really talks about, and the key here is fixed versus variable costs that a company incurs. The higher the fixed cost, the higher the upside for a business if they sell more, but the higher the risk if they sell less. Let me say that again. The higher the fixed cost, the higher potential upside for a business if they sell more, the higher potential downside if they sell less. In other words, a business that has high fixed cost is much more at risk than a business that has low fixed cost. That's why you see many small businesses not spending a lot of money initially when they start their business. They try and do it on a shoestring. So let's look at what this means. Vargo Video and one of its competitors, New Wave Company, both make camcorders. Vargo Video uses a traditional labor-intensive manufacturing process. New Wave has invested in a completely automated system the factory employees are involved in setting up, adjusting, and maintaining. So what they're telling you is that Vargo has a much higher percentage of variable costs, and you can see that here, and New Wave has a much higher percentage of fixed cost. You can see that here. The cost structure is the same. So if you add 480 plus 200,000, that's 680. And if you add 160 plus 520, that's 680. So they're making the exact same amount of money in both cases for these businesses. But what happens, we're going to look at the contribution margin for both and the contribution margin ratio for both. So if you look at Bargo, it's 40%, and at New Wave, it's 80%. So what happens is that for each incremental sales unit that New Wave does, they're going to make, for each incremental dollar, they're going to make 80 cents. For each incremental new sales dollar that Vargo does, they're going to make 40 cents. So, but by the same token, for each sales dollar that goes down, they're gonna make less and less and less for New Wave. So it's kind of a double-edged sword. But I want you to take a look at the contribution margin ratio. So, and that's what it's talking about here. New Wave contributes 80 cents to net income for each dollar of increased sales, while Vargo only does 40%. And a New Wave, which relies heavily on fixed costs, is more sensitive to changes in sales. So it's a double-edged sword. It's good and it's bad. So what are the break-even dollars? What are the break-even dollars? And we're looking at sales dollars here. For Vargo, it's 500,000, relatively low. But for New Wave, because they have such a high contribution margin and a high fixed cost, their break even is much higher. But once New Wave achieves the break even, then they are golden and they will make money and their profits will go up much faster. The difference in the ratios, you can look at margin of safety. Again, that's kind of the same thing. But you notice margin of safety ratio, it tells you that New Wave is much riskier than Vargo Video because Vargo Video can sustain a 37% decline in sales before they have an operating loss, whereas it's only 19% for New Wave. So operating leverage, what's a little bit of a summary here? It's the extent that net income reacts to given changes in sales. So the higher the leverage, in other words, the higher the fixed cost, the greater the net income. The higher the fixed cost, there you go. And when sales and revenues are increasing, higher operating leverage means the profits will increase more rapidly. And by conversely, when sales go down, that operating leverage can have a devastating impact on the business. So here's a degree of operating leverage. So we're going to look at that. Provides a measure of companies' earnings volatility. So it looks like the volatility of New Wave is almost twice as much as it is for Vargo Video. 533 to 267. And that's just taking the contribution margin divided by the net income and the contribution margin divided by the net income. So New Wave has the potential to have much more volatile net income. That's it for chapter 19. I look forward to talking to you again on chapter 20.